Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Neena Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Neena Mishra. In this episode, we focus on inflation, which is proving to be increasingly sticky, and it is one of the main reasons why stocks have been under pressure lately, because investors are weighing the prospect of more Fed rate hikes that would be needed to curb inflation. And in fact, the latest FOMC minutes also show that the Fed is inclined towards more rate hikes. So my guest today is Nancy Davis, founder and CIO of Quadratic Capital Management. Nancy manages the Quadratic Interest Rate, Volatility, and Inflation Hedge ETF, ticker symbol IVOL. She's a leading expert in financial markets and particularly inflation-related topics. She was named one of the 100 most influential women in U.S. finance. So Nancy and I will talk about the recent inflation reports and also about the broader economy. We'll also discuss tips and her ETF, IVOL. In the second part, I'll talk about some more ETFs that investors could consider for adding some inflation protection in their portfolios. Joining me now is Nancy Davis. Hi, Nancy. Welcome back. Great to have you on the show.
Thank you for having me back. Great to be here with you today.
So let's talk about inflation, because in the last few days, we have seen this complete shift in inflationary expectations and therefore expectations for Fed rate hikes as well. And you have been warning about inflation for over 2 years now, that inflation is not going to be transitory. It is not going to dissipate anytime soon. So I wanted to start with your thoughts on the recent inflation reports, CPI and PPI, which showed that inflation remains sticky. Tell us what you thought when you saw those reports.
Well, I have been a longtime advocate, as you pointed out, Neena, of owning as part of a diversified portfolio to have some inflation-linked assets. So the data that comes out, it's calculated like the CPI is just an index, right? It's a consumer price index. It's not the only way to calculate inflation, and it's calculated by the Bureau of Labor Statistics. It's not perfect because such a big piece of it is what they call owner-occupied rent. It's a shelter piece, which is about a third of that index, which is rent. And so that's kind of one issue that I see with the CPI. But I think going back to like the broader theme, I think it's just very important for investors to not be too complacent about whether one data point's going up or down, because I do think inflation is one of those things that, especially if you're, maybe retired and you're not going to be benefiting from wage inflation, you just have a higher cost of living. So in my opinion, I think having a diversified portfolio is really important, and having inflation-linked assets is super important as part of that portfolio.
So I read that BLS made certain adjustments recently in the weight calculations of CPI. So could you tell us more about those adjustments and how they are going to impact, how they have impacted the current CPI print, and are they going to impact going forward as well?
Yeah, so the Bureau of Labor Statistics can change their index, and they can change the weights. So they recently did change the weights. And that's kind of an issue because, again, like even the Fed doesn't use the CPI report. They tend to look more at the services part. Seems to be the focus right now for the participation rate in the labor market, and how low the unemployment rate is. And they tend to use the PCE more. So I think that's the thing to keep in mind is like no one index is perfect. And the Bureau of Labor Statistics did change, their calculation recently. But I think it's just very important to know that that's not the only index or not the only way to calculate it.
So, as you mentioned, there are several ways to look at inflation: CPI, PPI, and there's the Fed's preferred measure, PCE. So, do you have a favorite inflation metric, inflation gauge? How do you think of inflation?
My favorite gauge of looking at inflation expectations in the future is really not the policy rate that's set by the Fed. It's actually the shape of interest rates in the future. I think it's a very simple way to think about where lenders lend money, what their return expectations are of capital, what the cost of capital is. And I think using, a lot of people look at what happened in the 70s and 80s in the last inflationary period. And I think I try to caution investors about that, because the problem with that market is, like, even the inflation protected bond market didn't start until the late 90s. It started, the US Treasury issued their first inflation protected bonds in 97. And so I think it's very important to not only look at commodities, not only look at equities and real estate, which is what existed in the 70s, but look at other measures of inflation expectations. And I think a simple way to do that is using the inflation protected bond market, which is sometimes called TIPS, Treasury Inflation Protected Securities, which is where it's only resetting with the CPI index. So that's one kind of downfall of just using TIPS by themselves, is it's only CPI inflation. But then you can also look at the interest rate markets, which is, I think, also a nice way to look at where inflation expectations are in the future.
Very interesting. So I was also interested in your thoughts on other major economic reports, because they have also been hotter than expected. We got a blockbuster jobs report, and even the retail's report, sales report, suggested that American consumer remains very resilient. So tell us about your thoughts on other economic reports.
Yeah, well, it's definitely been very mixed. I mean, a lot of the indicators are pretty blockbuster. Like used car sales have been, people are out there spending money. Prices are going higher, and I'm sure that makes the Fed pretty darn uncomfortable, because we've had one of the fastest hiking cycles in our recent history, with 450 basis points of hikes in less than 12 months. If you, like, just for perspective, the Fed didn't start hiking rates until March of 22. So it's been less than 12 months with 450 basis points of hikes. And now we have even more hikes priced in the next 6 months. Now we have 74 basis points of additional hikes being priced in the next 6 months, just from these good job reports. So I think it's kind of a question of, like, is the Fed going to continue to, hit the nail with the same hammer, the same nail over and over and over again? Or is it time to be thinking about other solutions? Because the hiking policy rates can kill the demand side of the equation, but it doesn't impact, the participation rate or the jobs market or the supply side issues, or other things that are more, I'd say, pandemic related.
Yes, so market expectations of Fed rate hikes have really jumped in the past few days. What is your expectation of Fed rate hikes this year currently? Because we have seen these mixed economic reports, as you mentioned, at times very confusing economic reports. So do you think a soft landing is still possible, or there would be a hard landing, no landing? And where will we see terminal rates, say, this summer?
Yeah, I'm not sure, I guess, is the answer. Like, I do think it's very hard to predict what policymakers will do. You can see what's priced in very easily to markets using, things like Fed Fund futures, which is where I get these 74 basis points of additional hikes being priced in. But it's really hard to predict, how many, how quickly, when they're going to cut. The market does expect cuts, but I think looking very simply at things like the inverted yield curve, the curve inversion is, some of the most inverted yield curve that you've had, really going back in the history of the entire U.S. Interest rate swap market, going back to the late 80s. It's even more inverted right now. And so that curve inversion is really inconsistent with risk asset pricing, like where equities are or where credit spreads are. So something has to give. So either, the Fed needs to not hike as much, or risk assets are mispriced. It's kind of like we have two different markets and they're really conflicting messages right now.
Right, I agree with you. Very conflicting messages for sure. So we talked a little bit about you mentioned tips earlier, and many investors look at tips for adding some inflation protection in their portfolios. And I understand that you are not really a fan of tips. So there are some certain risks associated with the tips, there are complexities. So could you educate our listeners about the problems with tips, using tips in a portfolio?
Well, I do, inside of our IVOL ETF, we do own a lot of tips. So I don't think tips are bad, but I think they need tweaking because I don't think they say inflation in the name, but all tips only reset with the consumer price index. And like we talked about just a moment ago, Nina, even the Fed doesn't use that index. So it seems silly to only use that index to calculate inflation. That's one problem that exists with tips, is they only reset with CPI. And number two, they are bonds. And so like all bonds, all tips will lose money as based on the bond's duration exposure. So even a short dated tip, so it has shorter duration, but it's kind of a misnamed strategy. It really should be called less long, because it's still long duration. It just has less sensitivity. So it's going to lose less money when interest rates move higher. But the problem with short dated tips is you're taking more of a bet on short dated realized CPI. And you could get into a situation where realized CPI is falling, but future inflation expectations are increasing. So I think you have to kind of take a core tips portfolio and add some adjustments, because tips are still a pretty new product. Again, they only started in the late 90s. They haven't really seen a period of very high inflation. I do think it's important to be diversified, and having only things that existed in the 70s, like commodities or cyclical equities or real estate or gold or oil, those things may work, but they may not work. And so I think it's important to just be diversified, have a lot of different types of inflation-linked assets. And I think tips are okay if you can fix the problems with them being bonds to solve for a way to actually benefit from rising inflation expectations. When you have, if you think about what the yield curve is, right? The yield curve is largely related to investors' expectations for inflation in the future, right? It's very simply like where you would lend the US government money. Right now the yield curve is massively inverted. It's actually more inverted now than it was even in the late 80s. And that presents an opportunity for investors to take that core tips portfolio, but also add a way to benefit from rising inflation expectations outside of CPI.
So your IVOL ETF, as you mentioned, it tries to make certain adjustments to resolve some of those issues associated with tips. So tell us about those adjustments and more about the IVOL ETF.
So IVOL is mostly a tips portfolio. So approximately 80+% of the portfolio is that type of treasury bond. So it's just treasury inflation protected securities. And then we add fully funded options. And it's important to talk about being fully funded because we're not selling options, we're buying options. And so whenever you buy an option of any type, whether it's an equity option or a commodity option, or in our case, an interest rate option, the fund does not have an obligation to pay more than the premium you pay. So it gives you a lot of, there's no future funding obligations. So it's a specific type of instrument that has a when it pays out, it has that convexity, that positive convexity. So what that means is you can make potentially more than you lose with a positively convex instrument. And it's nice because inflation is a really risky asset. Inflation doesn't have a zero bound. It's not like buying a stock or a bond where it can only go to zero. Inflation expectations can go negative. They can fall. The market is already pricing in disinflation. The market could be pricing in deflation. And, break evens, if you look at short dated break evens, which is implied CPI, they fell massively in 2008, like extremely negative, especially short dated tips, because that's more of a view on shorter term CPI prints. So I think IVOL tries to solve that problem by benefiting from less Fed hikes or lower interest rates on the front end, which can potentially dampen the volatility of tips by itself. Like, for instance, IVOL has been around almost 4 years now. We listed the fund in 2019. And in March 2020, tips lost quite a bit of money. And even though we own tips, we had positive performance. And that's because we benefited from rising interest rate volatility because the fund owns rate volatility because it's long options. And also when the Fed cuts rates or doesn't hike as much, so right now we have that additional 74 basis points priced in the next 6 months if the Fed say that econ data was going to come out poor. So a bad jobs report, people think the Fed doesn't hike as much. That can steepen the curve with the front end rates going lower. Or it could actually, instead of losing less money with, any kind of bond with duration, will lose money based on that duration exposure when interest rates move higher. IVOL provides a way to potentially profit from when long dated rates move higher. So specifically, we have when 10-year interest rates move up, meaning bonds sell off, that's a way to actually have positive performance when inflation expectations increase. And you can see that in our performance looking at, the first quarter of 21, March 21, inflation expectations were increasing. This is before the Fed had pivoted from, they were still in the not even thinking about raising rates camp. And IVOL was up, I'm doing this off the top of my head, but it was up approximately 311 basis points, even though tips by themselves were down about 1.5%. And that's because of the duration exposure. So it's kind of to summarize, another way to look at inflation, another index per se, besides CPI, and a way to potentially lower the volatility when inflation falls, because inflation is definitely a risk-on asset class. So potentially lowering the vol on the downside when break-evens fall, when inflation falls, when real yields rise. Also, because it's long volatility, it's rate vol, not equity vol. And then also to do well when long-dated yields go higher, which is when bonds will lose money based on duration.
Switching gears a little bit, I wanted to talk about fixed income markets. And we have seen massive inflows into bond ETFs this year. And one of the reasons is that these major asset managers, including BlackRock and Vanguard, they had recommended owning high quality bonds in their annual 2023 outlook, particularly in the first half of this year, they said that fixed income instruments look more attractive compared to stocks. So you have worked in credit markets for many years. So I was interested in your thoughts on fixed income markets currently. Are there any areas that you like?
Yeah, I mean, I guess I would break it down into their two main types of risk in fixed income. There's rate risk, which is what investors have been very focused on right now. Everybody talks about duration and what's your duration of that bond portfolio, which is the sensitivity of the bond to a 1 basis point change in interest rates. All bonds are long duration. That's where IVOL kind of can step in to help. Potentially, but also the other type of risk is spread risk. And so there are a couple of different types of spread risk out there in fixed income, the most common one being credit spread risk, which, a simple example is if you have a stock and then if you own a bond on that same corporate, you have a different part of the capital structure, but you still have the same corporate beta. Right? If that company has, say, a bad management team or the sector doesn't perform well, or if there's higher labor costs or lower growth or, earnings miss, credit spreads widen when equities sell off, which makes sense because it's all the same corporate beta. So a lot of fixed income strategies will take credit spread risk. They might not take a lot of duration risk, but if you have, a portfolio with, say half of it be triple B minus credit, you might not have rate risk, but you have a lot of other risk. And then the other problem that I see with, kind of fixed income generally is a lot of portfolios will add structured credit. So specifically that's, a nice way of saying levered mortgages. Mortgages in the United States, homeowners are long the option to prepay. So owners of the mortgage are long the option, and the owners of the financial mortgage, very simply, are short options to homeowners. And so I think that's a really, it has a lot of jargon terms. Sometimes people call it, negative convexity or prepayment risk, but it's a nice way of saying owners of mortgages. The holder of the mortgage is long the option to prepay. The lender is short the option to the homeowner. And I think it's very important to understand when you have that mortgage risk inside of a portfolio, you do have exposure to rising volatility. And that's important to understand, especially because the Fed has started to allow some of their balance sheet to roll off with quantitative tightening, which is kind of the opposite of QE, right? For years and years and years, we've had the Fed out there buying bonds in the market. Now that pipe has turned off and we've actually flipped to allow some mortgages and treasuries to mature off the balance sheet. And so I think it's just super important to understand in these portfolios, if you don't have a lot of duration risk with rate risk, you might potentially have a lot of spread risk, whether it's credit spread or mortgage or agency spread risk.
Excellent. Those are some really good points that investors should consider and remember. Always a pleasure to have you on the show, Nancy. Thanks as always for sharing your insights.
My pleasure. Thank you so much for having me back. I really appreciate it.
That was Nancy Davis of Quadratic Capital. So for investors who want to add inflation protection in their portfolios, there's several options, and Nancy's ETF is one of them. And she alluded to other inflation protection instruments, including commodities, real estate, equities. So commodity ETFs in general offer some inflation hedge, and we discussed commodity ETFs recently with Invesco. Then I think equities owning high quality stocks and ETFs, high quality ETFs is also a good way to hedge against inflation, because these high quality companies have the pricing power, so they can raise their prices. So they will not protect from inflation over the shorter term, but over the longer term, these companies will realize earnings, and the earnings growth may be more than the rate of inflation. So investors would get inflation protection over the longer term with high quality stocks. So there are many, of course, high quality ETFs and stocks that we have talked about in previous episodes. Fidelity offers one which I like. It is the Fidelity Stocks for Inflation ETF. Ticker symbol is FCPI. So this holds high quality companies that tend to outperform during inflationary times. So if you look at the portfolio, Microsoft and Apple are currently the top holdings in the portfolio. Now, there are many other inflation beneficiary ETFs that investors could look at. The most popular is by Horizon Kinetics. It is called the Inflation Beneficiaries ETF. Ticker symbol is INFL. This basically holds companies that are expected to benefit from rising prices. Then VanEck offers one. It is called the VanEck Inflation Allocation ETF. Ticker symbol is RAAX. So this invests in multiple asset classes, including commodities, natural resources, equities, REITs, infrastructure MLPs, gold, coal mining equities, etc. There's another one by Astoria. The ticker symbol is PPI. This also invests in multiple asset classes, including cyclical stocks, commodities, and dips. Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. And also make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.